Okay. Well, look, good afternoon. It is a great pleasure to be here. Today is, of course, Saint Jean-Baptiste Day. Bonne fête à tous. Je sais que beaucoup des Franco-Manitobiens, une bonne Saint-Jean à toutes et à tous. When I started as governor of the Bank of Canada on June 3rd, 2020, the economy was in crisis. It was early in the pandemic, and Canada's unemployment rate was 14%, the highest on record. Inflation was well below the 2% target. It was actually slightly negative. The immediate priority was to avoid deflation and get the economy back on its feet. But since 2022, we've been fighting a new battle, high inflation. When the economy reopened, the combination of gummed-up global supply chains, a strong surge in demand, and Russia's unprovoked invasion of Ukraine sent inflation sharply higher. It peaked at just over 8% in June 2022. For more than 2 years now, our focus has been getting inflation back down. We've come a long way. Monetary policy has worked, and it's continuing to work. Since January, inflation has been below 3%, and our measures of underlying inflation have eased steadily. This has increased our confidence that inflation will continue to move closer to the 2% target this year. And as Jeanette underlined a couple of times, earlier this month, we lowered our policy interest rate for the first time in 4 years. Low, stable, and predictable inflation allows Canadians to spend and invest with confidence. It lowers uncertainty and encourages long-term investment, and it contributes to sustained job creation and greater productivity. This, in turn, leads to improvements in our standard of living. That's why price stability is our #1 priority. A key ingredient for price stability is a healthy labor market, one in which Canadians have the jobs they want, employers have the workers they need, and wages are growing in line, real wages are growing in line with productivity. Economists call this maximum sustainable employment, the highest level of employment the economy can sustain without triggering inflationary pressures. The health of the Canadian labor market is what I'm going to talk about today. In the 2021 renewal of our monetary policy framework, the federal government and the Bank of Canada agreed price stability is our primary objective. We also agreed monetary policy should continue to support maximum sustainable employment. Since then, we've done extensive work to bolster our analysis of labor markets. We've published a new dashboard of labor market indicators, and we've updated those benchmarks each year. So where are we now, and what's ahead? With higher interest rates, spending has cooled, and businesses have scaled back their hiring plans. Strong immigration has also helped the supply of workers catch up with demand, bringing the labor market into better balance. But it's now getting harder to find a new job, and that's particularly affecting younger workers and newcomers to Canada. And it suggests the economy now has room to grow without building new inflationary pressures. If we look at the labor market over the longer term, what we see is that Canada's growing, inclusive, and well-educated labor force has been a key advantage for our economy. It's been our primary source of growth for the past 25 years, and sustaining this advantage is critical to achieving strong, non-inflationary growth going forward. Well, that's my speech in a nutshell. So, if that's all you need, you can start checking your smartphone. But if you're willing to stick with me for another 15 minutes or so, I'm going to take a closer look at Canada's labor market, both in the short run and the longer term. Quand la pandémie a frappé, la fermeture de l'économie a entraîné 3 millions de pertes d'emplois au Canada. 2 millions de personnes ont vu leurs heures de travail réduites. Grâce aux vaccins et aux mesures budgétaires et monétaires exceptionnelles, le marché du travail s'est redressé très rapidement. Quand l'économie a complètement rouvert, le marché du travail est vite passé de la reprise à la surchauffe. La demande a rebondi parce que les gens reprenaient les activités qui leur avaient manqué durant les confinements. Les entreprises avaient du mal à trouver du personnel. Le taux de chômage est descendu à 4,8% en juillet 2022. C'est un creux qu'on n'avait pas touché depuis les années 70. On s'est retrouvé tout au coup avec 1 million de postes vacants. Les pénuries de main-d'œuvre sont devenues de plus en plus graves. Les salaires se sont mis à grimper et l'inflation a dépassé 8% à son plus fort. L'économie était clairement en surchauffe. À partir de mars 2022, la banque a beaucoup augmenté son taux directeur pour faire baisser la demande et les pressions sur les prix. À mesure que les taux d'intérêt plus élevés freinaient les dépenses, les employeurs ont commencé à signaler moins de pénurie de personnel. Le taux de postes vacants est descendu proche de sa moyenne historique et l'inflation a baissé. À mesure que les postes vacants baissaient, le taux de chômage s'est mis à augmenter. Il était de 6,2% le mois passé. C'est juste au-dessus du taux d'avant la pandémie, quand le marché du travail était proche du niveau d'emploi durable maximal. Ici, au Manitoba, le taux de chômage était de 4,9% en mai. Ça reste inférieur à ce qu'il était juste avant le début du pandémie. In November 2022, when we were raising our policy interest rate rapidly, I gave a speech about how we expected the labor market to adjust to higher interest rates and slower growth. I said that while the adjustment wouldn't be without some pain, it need not involve a sharp rise in the unemployment rate. With vacancies so high, much of the adjustment could come from businesses taking down job postings rather than laying off workers. This was based on what economists call the beverage curve, which shows the typically inverse relationship between job vacancies and the unemployment rate. The evolution of the beverage curve, as you can see in this chart, is a bit complicated, but it provides some insight into why the overall labor market has adjusted relatively smoothly to slower growth. So let me walk you through it. Before the pandemic, the economy was near full employment. Vacancies as a percentage of the labor force and the unemployment rate were both fairly low. That's the blue diamonds near the middle of the black curve. The pandemic severely disrupted the labor market. The unemployment rate rose rapidly to just about 14% in May 2020. That's the purple dot on the far right. With this disruption in the labor market, the entire beverage curve shifted up and to the right. We moved from the black curve to the orange curve. As the economy gradually reopened, job vacancies rose slightly and the unemployment rate came down quickly. This is reflected in movement from right to left along the orange beverage curve. That's the orange triangles. As the economy reopened fully, the beverage curve shifted back down. With less disruption, we began to see better matching between job seekers and job vacancies. And we moved from the orange curve back down to the black curve. The unemployment rate fell to a 50-year low of 4.8%. That's the black dot at the top left on the black beverage curve. And as I said, we moved from the orange back to the old black curve. As we raised interest rates and the economy cooled, businesses started to scale back job postings, and higher immigration helped fill job vacancies. The combined effect saw vacancies decline considerably, moving down the steep part of the beverage curve. That's the green dots on the black curve. We're now approaching the same part of the curve that we were in before the pandemic. The red dot is our most recent data point, May 2024. Okay, so what does all this dynamic mean? Well, when the unemployment rate is very low and job vacancies are very high, as they were when the economy was overheated, the curve is steep. So when you see the green dots moving down without moving much to the right, that means vacancies can come down a lot with only a relatively small increase in unemployment. This is the soft landing scenario. It's always been a narrow path, and we have yet to fully stick the landing. Looking forward, the unemployment rate could rise further, particularly as the Beveridge curve is getting flatter. But we continue to think that we don't need a large rise in the unemployment rate to get inflation back to the 2% target. Inflation is not yet 2%, but it is a lot closer. And with further and sustained easing in underlying inflation in recent months, we are more confident that inflation will continue to move closer to the target. So now turning to wage dynamics. When the labor market was tight and inflation was high, wage growth increased. And depending on the measure you look at, wage growth peaked between 4.5% and 6%. This was roughly twice the pre-pandemic average of 2 to 3%. With inflation now much lower and the labor market coming into better balance, we are starting to see evidence the wage growth is moderating. The latest numbers on a 6-month basis suggest wage growth has eased to about 4%. This is clearly down from the peak, but still above the pre-pandemic average. Now, the fact that wages are moderating more slowly and inflation is not the fact that wages are moderating more slowly than inflation is not itself surprising. Wages tend to lag adjustment in employment. Going forward, we will be looking for wage growth to moderate further. In assessing the implications of wage growth for labor costs and inflation, it is important to separate out wage gains that reflect productivity improvements. Wage gains that are backed by productivity gains do not increase unit labor costs or inflationary pressures. In recent years, the number of higher-paying jobs in the economy has grown more than the number of lower-paying jobs. And what that means is that overall wage growth has been higher. To the extent that this reflects workers gaining valuable new skills or finding jobs that better match their skills, it shouldn't add to unit labor costs and inflation. So when we're assessing the inflationary implications of wage growth, we place more weight on wage measures that try to control for occupational shifts or labor cost measures. And these are running a little lower than other wage measures, particularly if you use the more timely 6-month rates of change. So that's the broad adjustment in the labor market. It's been a relatively smooth cooling. But the aggregate masks some important differences. Some workers are feeling the slowdown more than others. Employers may not be laying off workers in large numbers, but less hiring over the last year means it's harder to find that first job. That hurts new graduates and younger workers, as well as newcomers to Canada. So let me take a moment to dig into some detail here. The unemployment rate for newcomers is rising much faster than the overall unemployment rate. Newcomers are taking longer to find a job. Look, that's hard on them. It's making it more difficult to integrate into the Canadian economy. It also suggests that the government has some room to slow the growth of non-permanent residents without tightening the labor market too much and causing significant labor shortages. If you look at younger workers, youth employment has also been softening. Again, the evidence suggests that people established in their jobs are not experiencing much of an increase in unemployment. But with fewer new job vacancies, it's taking longer for young people entering the labor market to find a job, so their unemployment rate has risen. It's now about 2 percentage points above its pre-pandemic average. Now, it's worth stressing that labor market adjustments are never evenly distributed, and monetary policy can't target specific parts of the labor market. But as we set monetary policy, the bank needs to look beyond the aggregate to understand what this cooling in the labor market means for different people. The overall unemployment rate is close to its pre-pandemic level, and it's still relatively low. But the slowdown in hiring has led to increases in the unemployment for younger workers and newcomers to Canada. These workers are feeling the effects of slower growth more than others, and we need to recognize this. This matters for monetary policy because it indicates there is some slack in the labor market, That suggests the economy has room to grow and add more jobs without creating new inflationary pressures. It also matters for household financial stress. People who find it hard to get a job often find it harder to keep up with their credit card and other debt payments. Many indicators of financial stress declined during the pandemic, but they're now back to around where they were before the pandemic. And late payments for credit cards and auto loans are actually above pre-pandemic levels. We see this stress particularly among renters, and these are often these younger workers and newcomers to Canada. So let me now shift gears. That was a short run. I'm going to pivot to looking at the labor market from a longer run perspective. For years, Canada's biggest economic advantage has been its labor force, and that includes people with jobs and people who are looking for jobs. Growth in employment in Canada has been much stronger than in the United Kingdom, the Euro area, and even the United States. And this was true before the pandemic, and it was true through the pandemic recovery. Our labor force advantage reflects three key strengths: high labor market participation, strong immigration, and a good education system. So let me take each of these in turn. First, Canada's labor force participation is stronger than in these other countries. Our participation rate for women is at the top of the G7, and that's been helped by affordable childcare and flexible work arrangements. Second, Canada attracts some of the world's best and brightest students and workers, and we actually integrate them relatively quickly into the Canadian economy compared to many other countries. And finally, our education system does a good job overall of developing the workers the economy needs and businesses want to hire. Our post-secondary attainment level in Canada is the highest among advanced economies, although we do trail the United States in the attainment of advanced degrees. Our Achilles heel is productivity. We have been very good at growing our economy by adding workers. We've been much less successful at increasing output per worker, and this is catching up to us. While we managed to make up for our productivity underperformance from 2000 to 2019 with strong labor force growth, since the pandemic, GDP growth in Canada has been weaker than in the United States. As my colleague, Senior Deputy Governor Carolyn Rogers highlighted in March, weak productivity growth in Canada is a long-standing issue, and it's reaching emergency levels. As good as we've been at growing our economy by adding workers, we need more than one engine. Moving forward, as any great hockey coach would tell you, we need to play to our strengths, and that's growing our labor force while we tackle our weaknesses, investment and productivity. We should not take our labor market strengths, or those advantages, we should not take them for granted. We need to maintain and build on them. That means continuing to improve the accessibility of childcare. It means concerted efforts to improve labor force participation of groups that have traditionally been left out. And here I'm thinking especially of Canada's Indigenous peoples, a growing pool of young talent who have been excluded from economic opportunities for too long. It means aligning immigration to long-standing labor shortages in key areas like skilled trades. It means properly recognizing credentials and qualifications and experience of immigrants. And it means sustaining and enhancing our education system and ensuring it is developing students for the jobs of the future. Tackling our productivity problem will be harder, but it is vital. Productivity growth ensures our businesses are competitive in international markets. It pays for higher wages and it underpins rising standards of living. And with an aging population and limits to how many immigrants we can absorb each year, improving our productivity growth will become more important to sustained trend growth in Canada. Now, on the surface, the cause of low productivity growth in Canada is clear enough. On average, businesses in Canada invest much less per worker than they do in the United States. And with less investment in machinery and equipment, particularly information and communication technology, workers in Canada have less and older machines and computers to work with. And weaker investment in intellectual property means they have fewer innovations to help them work smarter, faster, and more efficiently. So it's not surprising they're less productive. But the deeper question is, why have we had systematically less investment in Canada than in the United States? Or to put the question in the positive, how do we make Canada more investable? Finding answer to these questions is going to be critical if we want to increase non-inflationary growth and raise the standard of living of Canadians. It's time for me to conclude. Price stability is our primary mandate, and a healthy labor market and price stability go hand in hand. If employment is well below its maximum sustainable level, the economy is missing jobs and incomes, and this puts downward pressure on inflation, pushing it below our 2% target. That's what happened early in the pandemic. When the economy is operating above maximum sustainable employment, businesses aren't able to find the workers they need to keep up with demand. That puts upward pressure on prices and pushes inflation above our target. That's where we were in 2022. Aujourd'hui, l'inflation est beaucoup plus près de la cible de 2%. Et puisque l'économie a des capacités inutilisées, on peut la faire croître et créer des emplois sans nuire au retour graduel de l'inflation à la cible. On n'est pas encore tout à fait là, mais on ne peut pas savoir, s'il y aura d'autres obstacles sur notre route. Mais on semble être sur la bonne voie. Analyser le marché du travail sous différents angles est très important pour nos décisions de politique monétaire. À long terme, la santé du marché du travail est essentielle à la forte expansion non inflationniste de l'économie canadienne. Ce qu'on arrive à bien faire, c'est pousser notre économie vers le haut en agrandissant notre main-d'œuvre. Pour garder cet avantage, il faut continuer à investir dans nos trois grandes forces. Un marché du travail inclusif, une immigration judicieuse et un système d'éducation robuste et accessible. On doit régler notre problème de productivité tout en continuant de miser sur ses forces. Today, inflation is much closer to the 2% target. And with some slack in the economy, there is room for the Canadian economy to grow and add more jobs, even as inflation continues to move closer to the target. We're not yet back to 2%, and we can't rule out that there will be some new bumps along the way. But increasingly, we look to be on our way. Assessing the health of the labor market from various angles is an important input into our monetary policy decisions. Beyond the near term, a healthy labor market is critical to strong, non-inflationary growth in Canada. We've been successful at expanding our economy by growing our labor force. To sustain this advantage, we need to keep investing in an inclusive labor market, smart immigration, and a strong and accessible education system. Let's not take these for granted as we tackle our productivity problem. Thank you.
Now, to facilitate their fireside chat, please welcome to the stage Winnipeg Chamber President and CEO, Loren Remillard.
Governor Macklem, thank you very much. Great speech. Really appreciate you delivering it here in Winnipeg. And I think it'll be good luck. I think the Oilers will pull through. So just my prediction there. We don't have a lot of time, so I do want to jump into, we have a number of questions that our members had submitted. And the first one, of course, being inflation. During the last few years, inflation tended to be more of a theoretical concept than a practical reality for a number of Canadians. Inflation, though, has historically been transitory. But in the aftermath of the pandemic, we found that inflation was unexpectedly entrenched, as evidenced by the CPI median and trim. Going forward, what does the Bank of Canada plan on doing to better forecast and react to possible bouts of entrenched inflation?
Well, look, we were surprised by how much and how rapidly inflation rose in 2022. And we have been asking ourselves some tough questions, and we have been looking at, well, why were we surprised? In July of 2022, in our monetary policy report, we provided a first accounting of our forecast errors. And what that showed is about 2/3 of the forecast error reflected international events. About the other 1/3 was domestic. And I think one of the key takeaways from that is, look, Canada's a very open economy. That's a big advantage for Canada. But global events can have a big impact. Global demand for goods was strong coming out of the pandemic. Global supply chains were heavily disrupted. Then you had Russia's unprovoked attack of Ukraine, which further pushed up oil prices and food prices. So the whole food complex, the whole sort of goods side of the price complex, goods price inflation rose very rapidly. And we can't influence what happens in global markets, but we do need to manage that. And as businesses, you need to manage that. And I know you are looking at your supply chains. You're thinking about how to manage that better. There are some domestic lessons though, and we are taking these to heart. I think, as you mentioned, typically supply shocks have had a relatively, dare I say, transitory effect on inflation. What we saw this time was it's a lot easier to restore demand. Our interest rate policy affects demand. It's much harder to restore supply. And when supply is gummed up and demand is strong, that can have significant inflationary consequences. We've had supply shocks in the past. They've tended to be relatively temporary, and they haven't happened at the same time that we had a big surge in demand. But when you get a more persistent supply shock at the same time demand's really strong, yes, that can have a big effect on inflation. So that is something that we are building into our analysis, we are building into our models. I think the other thing, the other lesson, and this isn't really a new lesson, if you're as old as me, you were around in the 70s, but for many Canadians, this was their first experience with significant inflation. And we were reminded just how painful inflation is. You go to work, you work hard, you probably got a raise, but then you go to spend your money, you go shopping, and you realize, oh, this salary is not going as far as it used to. That's the corrosive effect of inflation. It makes people angry. It feels unfair. People lose confidence in our economic system. And I think it really underlies just how important it is to get inflation back down. We are well on our way. We've come a long way.
So just as an extension on that, I want to kind of explore a little bit the concept of zero lower bound. Given the difficulties of bringing down inflation post-pandemic, where do you stand on revisiting the bank's operating inflation band of 1% to 3% and its target rate of 2%?
Look, I think the 2% inflation target has served Canada and Canadians very well. The 1 to 3 band, it gives a sense to Canadians that's kind of the normal variation in inflation. Inflation is going to be within that about 80% of the time. Obviously, the last several years was an extraordinary period. We were way outside that band. We're now back in the band. And if you want to stay in the band 80% of the time, you need to aim for the middle of the band. And we definitely want to get inflation back to the 2% target. One of the strengths of our monetary policy framework is that we review our framework every 5 years. We last reviewed it in 2021. The next review will be in 2026. We're not there yet, but it's not that far away. And I think one of the questions we will want to look at is the 2% target with the 1 to 3 band, is that fit for purpose going forward? Is that the best monetary policy framework for Canadians as we look forward? So we will review it, and we haven't started that work yet, but that certainly will come.
So, and you touched on this previously, and staying a little bit with inflation, I want to talk a little bit about supply side cost push inflation. With the rise of globalization, and you touched on this in your speech and in the previous answer, globalization, international trade, commodities and their prices can now import inflation from abroad. A domestic policy like monetary policy, however, was not designed to adequately affect foreign supply side cost push inflation. So what ideas does the bank have to address this evolution?
Well, it's a tough question. I mean, we've always been a very open economy. We've always been affected by developments outside the economy. And over time, as all our economies have become more integrated, that's only become bigger. That doesn't mean, though, that we can't control inflation. We can control inflation. We are controlling inflation. Inflation was 8%. It's the latest number, 2.7. We're going to get another number tomorrow. We'll see. But inflation has been came down pretty quickly at first. More recently, it's been steadily ticking down gradually. And if our forecasts are right, if the economy evolves broadly in line with what we're thinking, we expect that will continue. There are always going to be relative price shocks. There are always going to be some prices that are going up more in the economy than others. That's actually how the economy works. When demand is strong for something, the price goes up. Businesses start to make more of it, increases the supply, that brings the price back down. The purpose of monetary policy is not to try to control all the prices. No, we want prices to work. What we don't want is to have a generalized increases in prices. That's what inflation is. It's not one price going up. It's many prices going up, and that's what we saw back in 2022. If you look at the distribution of price changes, 80% of prices, the components in the CPI, 80% of them were rising faster than 3%. It was a very generalized price increase. That's inflation, and we want to get inflation back down to 2% because that's where the economy works better.
So a big part of your speech, of course, was productivity. It's something that our members deal with. We know it's been an issue of concern for a while. I note the Bank of Canada's own communications around it, noting in 1984, Canada's productivity, 88% of the American economy per hour. Fallen by 2022, it had fallen to 71%. We know productivity's fallen 12 of the last 15 quarters. But I want to ask you, when we look at the steps that business is taking, for businesses, they're often purchasing productivity-enhancing equipment with debt in US dollars. Currently, though, interest rates and exchange rates in the business cycle are not exactly favorable. So how do you respond to arguments that the bank should be more aggressive in rate reductions to support business productivity investment? If not more aggressive, what other solutions are proposed?
As I outlined in my remarks, our productivity problem is long-standing. We've had weak productivity growth at low interest rates. We've had weak productivity growth at high interest rates. So, yes, obviously interest rates affects your investment decisions, but it's something deeper than monetary policy. And as I said, on the surface, it's pretty clear. I mean, Canadian workers have less and older machinery and equipment and computers to work with, so it's not too surprising they're less productive. But the question is, why have we had less investment in Canada? I have to say, I do find it puzzling. When I look at the economy, and you look across almost every sector of the Canadian economy, in almost every sector, we have a fabulous Canadian business that is investing, competing, winning in global markets. So it's not as if we can't do it. We can. And you look across every sector. I'm not going to name the companies, but I'm sure you could. The other thing we saw during the pandemic, the economy goes over a cliff into the pandemic. What do businesses do? They invest heavily in new digital technology so their workers can work at home, so they can serve their customers remotely. The moment of highest uncertainty now, I realize, I don't want to nobody wants another crisis to force these kind of decisions. But We know the capability is there. And I think we need to ask ourselves some tough questions about why aren't we seeing systematically more investment in Canada. When I think about it, I think there's kind of three buckets. The first bucket is we've actually done pretty well on framework policies. Monetary policy, low inflation, that's a framework policy. It creates the underpinning for businesses to invest. When inflation is low and stable, that's one less uncertainty for business. When inflation is low and stable, interest rates tend to be lower and more stable. That's less uncertainty for business. That creates the conditions. There are a whole other series of framework policies: competition policy, competitive tax policy, prudent fiscal policy, trade policy. I mean, Canada has some of the best trade access in the world. As other countries look increasingly inward, it's going to be really important that we maintain that. We need to continue to invest and make sure we've got those best framework policies. The second part are obstacles we've created. There are too many small differences between provinces in the regulation of goods and services, in the accreditation for different types of workers. We're not a huge market in Canada. When we divide it up into smaller bits, it makes it more difficult for businesses to get economies of scale. That's something we've done. If we've done it, we could undo it. It would take some will, but we could undo it. And then I think there are some bigger questions that really are going to require some thought. For example, we need more housing in this country. We need more investment in residential structures. We also need more investment in machinery and equipment, more investment in new ICT technology. How are we going to get both? We've done a pretty good job, I think, in recent years in developing our startup innovation ecosystem. We're having more trouble scaling up. How do we get more scale up? We have many successful Canadian-based businesses. We also have many big multinationals in Canada. How do we find the right balance between them? So, there's some tough questions that we need to think about. And really the message here is, if we want to improve productivity, we need a concerted focus on this. It's a problem that's built up over a number of years, and we're going to need a concerted focus on this over a number of years.
You had mentioned frameworks and fiscal policy, and I have to admit we're down to time. I'll ask you one more last question, but the question I was going to ask you was around capital gains, but I know that gets more into fiscal policy and its implications for productivity.
Don't waste your question.
Yeah, no. I actually had it written down, and then I just went, no, move on. But I'm going to try to merge two questions, and it's really around credibility, transparency. Economists, practitioners, monetary policy can be a confusing concept to understand outside of those. How does the bank plan on improving transparency and understanding of its role in policies for the general public? And then just maybe as a bit of a follow to that is, especially we're seeing politically commentary, both here and abroad, political forces seeking to influence monetary policy and the such. So in that context, how do you enhance transparency and credibility, understanding of everyday Canadians that, as you noted, are struggling? Inflation's affecting their ability to deliver a quality of life that they're hoping for their families.
Look, I think the bottom line is we're a public institution. We work for Canadians, and we have a responsibility to be accountable for Canadians. And actually, it's even more than that. The other thing we've learned is that the more people understand the objectives of monetary policy, they understand how monetary policy works, they understand how our actions are contributing to achieving our objectives, the better monetary policy works. If you go back, Gordon Thiessen was governor from 1994 to 2001. And Gordon really transformed the thinking at the Bank of Canada. He introduced the first monetary policy report, our first publication of our inflation forecast, our GDP forecast. And he moved interest rates to 8 fixed decision dates, eight interest rate announcements a year. And every governor since Gordon has built on that. David Dodge, Mark Carney, Stephen Polas. Since I've been governor, it has been a period where Canadians are much more interested in monetary policy than they've been, and we have really been working hard to speak to Canadians where they are, listen to their perceptions, their anxieties, and try to speak to what's on their mind. So, some of the things we've done, we now have a press conference after every monetary policy decision, not only 4 of the decisions. We've introduced a summary of deliberation. So 2 weeks after a decision, we publish what we actually discussed in our meeting. What is on the minds of the governing council members? What were the main factors that led to the decision? What did we see as the main risks? How did we achieve consensus? Increasingly, we do produce some very beefy publications, but increasingly we're providing short summaries of those. We're using video. You can even see me on Instagram now. We're also, myself and the deputy governors are also traveling more across the country, because it's not just about communicating to Canadians, it's also about listening to Canadians, understanding their perceptions, understanding what's driving their decisions, understanding their anxieties. And you mentioned the political element. Yes, politicians are giving us advice from time to time. And look, they're reflecting what they're hearing from their constituents. Their constituents are worried. They're anxious about their mortgage. They're really feeling the effects of inflation. We regularly listen to Canadians. We survey Canadians regularly. We survey Canadian businesses regularly. And we're making a real effort to get out across the country to hear directly, person to person. So that, our decisions are taken independently. We don't worry about what politicians say, but we do worry about what Canadians think, and that does feed into our decisions.
No, thank you very much. Greatly appreciate this opportunity. Our time's done, but on behalf of the Winnipeg business community, thank you very much. If we could give the governor a round of applause. I'd like now to welcome back.
Okay. Well, good afternoon, everyone. My name is Paul Bodicher. I am the Director of Media Relations at the Bank of Canada, and I'm very happy to be back here in Winnipeg to moderate this press conference by Governor Macklem. We've got about 20 minutes. We'll start here in the room, and then I've got a number of reporters online. Please limit yourself to one question so that everyone will have the chance to participate. If I fail to do so, please state your name and affiliation. Et bien sûr, comme toujours, libre à vous de poser vos questions dans la langue officielle de votre choix. We're going to start here in the room with Gabrielle Pichet from the Winnipeg Free Press. Gabrielle, here's the microphone for you to use.
Oh, thank you. Hi. So given the newcomer and youth having a harder time finding jobs right now, what, if any, monetary policy changes is the Bank of Canada looking at to address that?
Yes, as you mentioned, while the adjustment of the labor market overall, it has cooled reasonably smoothly, and the aggregate unemployment rate is still relatively low. If you look underneath the hood, you can see that the slowing of economic growth has affected some workers more than others, and it's particularly affected younger workers and newcomers to Canada. And that really reflects the fact that businesses aren't laying off very many workers, but they have slowed their hiring. So those people entering, looking for their first job, it's taking longer. For monetary policy, what that's telling us is that even if the unemployment rate's relatively low overall and vacancies are down at about pretty close to normal levels, there is some slack in the labor market. There is some room for the economy to grow, for growth to pick up, and for more jobs to be added to the economy without getting in the way of further easing in inflation, without getting in the way of getting inflation back to target. So that is something that is feeding into our monetary policy decisions. As we've said, we've been pretty clear. We've seen inflationary pressures ease. We think they are continuing. They will continue to ease, and that led us a few weeks ago to cut our policy interest rate for the first time in 4 years to 4.75%.
Okay, thanks for that. We're going to go online now, and our first question, I'm going to go to Najoud Al-Maliz from the Canadian Press, please. Go ahead, Najoud.
Hi, Governor. The central bank has been more outspoken on this productivity issue in Canada lately, and I'm just wondering if you could talk a little bit about what you think what role the Bank of Canada plans to play in this conversation moving forward. Do you plan on, for example, publishing research looking at maybe some of the solutions to the problem?
Najud, so our direct role really is to achieve our mandate, price stability. I mean, price stability is, it's a core framework policy. And when inflation is low and stable, it's one less thing for businesses to worry about. It's one less thing for households to worry about. So, they can save and invest with more confidence. And the other element is that when inflation is lower and stabler, interest rates tend to be lower and stabler. So again, it's one less thing for businesses and households to worry about or not worry about as much. So, that's our direct role, but, our real message here is, if productivity growth really is central to raising the standards of living of Canadians, and it's going to become increasingly important to support trend non-inflationary growth going forward. It's not a new problem. We've been struggling with productivity growth for some time. What that really points out is there's no simple solution. And really our message is, most of the tools here are beyond our control. They're not in the hands of the central bank. But our message is, if you want more non-inflationary growth, we're going to need a concerted discussion between businesses, governments, and academics, civil society, on how are we going to get productivity growth up in Canada. We've been relying heavily on growing our labor force. We've actually been very good at that, but we're going to need more than one engine. That's why we're focused on it.
Okay, I'll go now to Greg Quinn from Market News. Go ahead, please, Greg.
Hello. You mentioned in the speech that the bank's mandate has clarified the ability to maximize employment within the prime goal of getting inflation right. I mean, it used to be thought before the pandemic that low inflation and maximum unemployment could be done at the same time through monetary policy. We've obviously had a couple of very extraordinary years here in Canada. As inflation is settling down, can you talk about what your thinking is around how forcefully the employment goal can be pursued? Can both still be accomplished at the same time? Is there some kind of trade-off emerging?
Well, Greg, I guess a few points off the top. First is, it's important to emphasize that price stability is our primary objective. It has been since the inflation target was first announced in 1991, and that remains. You have seen in recent years, we have been providing more analysis of the labor market. We've been talking about the labor market more, and there's a good reason for that. I mean, low stable inflation and a healthy labor market go hand in hand, and I explained that in the conclusion to my remarks. As you point out, depending on what kind of shocks you have on the economy, they can affect employment and inflation differently. So when you have mostly demand shocks, employment's weaker, inflation's down, monetary policy stimulus tends to solve both problems, gets inflation up to the target, gets employment growth growing again. When you get big supply shocks that really disrupt the system, the two can go in opposite directions. That is certainly a more difficult situation for everyone. It's more difficult for monetary policy, it's more difficult for Canadians. Through the last 4 years, we've had exceptionally large supply shocks, and that is something we've had to manage. There's no perfect solution, but I think we have learned some lessons about how supply shocks affect the economy, and we are taking those on board in our own monetary policy analysis. And I think, while I don't think that the next few years are going to be anything like the last 4 years, there are a number of reasons to believe that there could be more supply shocks going forward than we've seen over the last 25 years. So we are going to we do need to think about how to manage them better.
Okay, our next question comes from Mark Rendell from the Globe and Mail. Go ahead, please, Mark.
Hi, thanks, Governor Macklem. I wanted to essentially put your own question that you asked in the speech back to yourself on the productivity question. You asked, the deeper question is why we've had systemically less investment in Canada than the United States. And then you asked, how do we make Canada more investable? I'm wondering what your thought on the answer to that question is.
Well, Mark, it's a tough question, and I won't pretend to have all the answers. I think, the real message is we need a concerted focus on that question. As I said in the Q&A after my prepared remarks, I think of it in sort of three broad buckets. I think there's the first two buckets I think we know a fair amount about. The first bucket are really the importance of framework policies. And if you're the governor of the central bank, top of that list is price stability. And as I just outlined, the economy works better when inflation is low and stable. It's good for investment. That's good for productivity. But there's a lot more. There's a whole range of framework policies. Trade policy. Canada actually has very good trade access between USMCA, the extended TPP, the CETA agreement with Europe. As other countries look increasingly inward, it's going to be really important that we do our best to maintain that. We need, there's competitive tax policy, there's competition policy, there's prudent fiscal policy. So there's a whole range of framework policies. I actually think we're pretty good at those in Canada, but we have to make sure that those are the best that they can be. We've also learned, though, over the last 25 years that while those are necessary, they're not sufficient. And this really gets you to the other two buckets. And the second bucket are obstacles that we've put up to productivity. We have too many small differences between provinces in the regulation of goods and services, in the accreditation of different types of workers. I'm not pretending it would be easy, but we created these barriers. We could get rid of them. Canada's not a very big market to start with, and when we carve it up into smaller markets, we really lose economies of scale. So that's it. The other thing I hear a lot when I travel around the world is international investors. They're very interested in Canada. We're right next door to the world's biggest, richest economy. We've got a stable democracy. We've got good trade access, reasonably prudent fiscal policies. There's a lot of things going for Canada. Often you hear, though, that regulatory approvals are slow. We could take a look at that. So those are some of the things we've done to ourselves. There are also a whole range of bigger questions that I think are going to need more thought. Role of multinationals versus home headquartered businesses. Investing in houses, investing in machinery and equipment. There are a number of big questions. I don't have all the answers, but I think we need to collectively be thinking about those.
Okay, our next question is Randy Thantong-Knight from Bloomberg News, please. Go ahead, Randy.
Hi, Governor. In your speech, you talked about smart immigration. Could you expand on that? And related to that, has the bank come up with any estimates on the level of newcomers that the Canadian economy can handle each year, and as well as the right composition between permanent residents and temporary immigrants?
Randy, we don't do immigration policy. I think the message was pretty clear. If you compare us to other countries, we actually do a pretty good job. We have our economic-based immigration system does a pretty good job of bringing people into Canada who can integrate reasonably quickly into the labor market. Businesses are pretty good at doing this. There's government programs that help that. I think, though, that there are limits to how big our immigration, how quickly we can absorb people into the economy. There are limits to our immigration policy, and I think the message here is, look, this has been a big success for us. It's been a real strength. Let's not lose sight of that. Let's let's make sure we're focused on smart immigration policy going forward. It's been a key source of growth to Canada. Let's keep it that way.
Our next question is from Max Sato from Base News. Go ahead, please, Max.
Thank you, Paul. Thank you for the time, Governor. My question is about among the G7 economies, central banks are either shifting from tightening towards more neutral policy stance, and then, except in Japan, the shifting from large scale easing towards tightening. But in each country, the process is very slow and central banks are careful. Does it reflect the kind of uncertainty we're talking about that we've seen in the past few years, and also structural issues? Interestingly, both Canada and Japan have productivity gain problems. So does this uncertainty is making more uncertain for you to say when your next step is going to be?
Well, I can't really speak for other central banks. I have to say, speaking as the governor of the Bank of Canada, I don't feel like monetary policy is slow. In the 4 years since I've been governor, we have done a tremendous number of interest rate changes. We raised rates. It was the fastest, most rapid increase in rates in the Bank of Canada's history. We held for a number of months at 5. We've now cut to 4.75. So I don't feel like things have been slow. I think the economy has been changing rapidly, and monetary policy has had to adjust rapidly. But getting to the second part of your question, yes, uncertainty. You don't know. There's a lot of things. None of us have a crystal ball. We don't know what's around the corner. We don't know what the future is going to bring. It's even hard at times to figure out exactly where the economy is. We get information with a lag. We have imperfect information even on where the economy is right now when we're taking decisions. So yes, that does make you you have to manage that uncertainty. Sometimes that means go more slowly. Other times, though, it can actually mean go more quickly. When the pandemic struck, there was obviously enormous uncertainty. The Bank of Canada extremely rapidly dropped interest rates, provided a whole series of liquidity facilities to start. That was at a time of enormous uncertainty. It was a time for the central bank to move extremely rapidly to try to address that uncertainty. Other times, uncertainty means, yes, you need to move sort of a step at a time, take in the incoming data, see where you are, consider your next move. So there isn't sort of a single recipe I can give you on the implications of uncertainty.
Okay, I think we've got time for our last two questions. First up will be Paul Vieira from the Wall Street Journal. Go ahead, please, Paul.
Governor, was your intention to at least explain
Can you speak up a little bit, Paul? We're having trouble hearing you.
Okay, 1 second.
That's better.
Can you explain, was it your intention today to explain why the Bank of Canada officials might not be as concerned about wage gains as some in the markets, or even are you less concerned about the wage gains and the upward pressure that they apply on inflation? Was that your intention?
Paul, my intention today was really to highlight a number of the things that we're looking at in the labor market, both at a very macro level, but also at a more disaggregated or granular level, and how those feed into monetary policy. So on the topic of wages, I mean, if you look at, there's various wage indicators, and they're not all moving in exactly the same. They're moving to different degrees. So the message there was, yeah, we look at a whole range of wage indicators, and you know, we're looking for some consistency across those. We're looking for, I mean, wage growth has moderated, but it is still high relative to productivity growth. So we are looking for further moderation. And then I really wanted to highlight that from a monetary policy perspective, not all wage measures are equal. The ones that do a better job of separating out wage gains that are linked to productivity, those are the ones that we're more focused on, because wage gains that are linked to productivity, that's a great thing. People are more productive, they're getting rewarded for that. That's not causing inflation. That's not something of concern to the central bank. So I did want to highlight that one of the things you're seeing in the Canadian economy is there's been more growth in high-paying jobs than in low-paying jobs. So when you look at the salary overall in the economy, it's been going up partly because of this shift into higher wage jobs, which tend to be higher productivity jobs. And so, you know, the part that's linked to productivity is not causing inflation. So we're more focused on those measures. That doesn't mean, though, that we don't need to see further moderation in wage growth. I mean, even if you look at those measures, wage growth is running somewhat high relative to productivity growth and a 2% inflation target. And, you know, if you go back to our summary of deliberations, what you saw there, you know, some concern among the governing council that if that doesn't come down further, particularly services which tend to be more labor intensive, you could see service price inflation, ongoing pressure on service prices. So that is something we're watching carefully. Really, my purpose today was to provide a little more depth on which measures we're watching most carefully.
And our last question comes from Promit Mukherjee from Reuters. Please go ahead, Promit.
Thanks, Paul. Hi, Governor. Wanted to ask you about the rate cuts. So how many rate cuts do you think we will require this year to give some substantial relief to homeowners who are renewing mortgage next year? Because 1 or 2 cuts doesn't really move the needle, does it?
Well, how many rate cuts this year? Well, we're just going to have to see. I mean, I think we've been pretty clear. If the economy evolves broadly as we expect, and we continue to see inflationary pressures easing, it is reasonable to expect further cuts in our policy interest rate. But we've been very clear, we're going to be taking it one meeting at a time. And what does that mean? It means, we're going to be looking at the data that's coming out. We're going to be assessing what that means for the future path of inflation, and that really will determine what we do with interest rates. With respect to mortgage holders, we are watching very closely. We actually have very good data on mortgage renewals. We have anonymized data on mortgages held at federally regulated financial institutions. That's about 80% of the mortgages in Canada. So we can see how homeowners, mortgage holders are adjusting to higher rates. And what we see is that there's no question higher rates are squeezing them. They are cutting back on by and large, they're paying their mortgage, but they are cutting back on other expenditures. And we know that there are, we're about half, since we started raising rates, about 50% of the mortgages have renewed. That means there's about 50% to go. And those renewals actually will have a bigger reset than the ones that have happened already on average. So yes, that does mean that there are more effects to come, and that is something that's factoring into our monetary policy decisions. We did lower our policy rate by 25 basis points, and as I've said, if the economy evolves, if inflation evolves broadly as we expect, it is reasonable to expect further cuts in our interest rate. I would just end, though, in stressing is that we're really trying to balance the risks. Look, look, we don't want monetary policy to be more restrictive than it has to be. We don't want interest rates to stay higher than they have to be to get inflation back down. So yeah, we want to see interest rates come down too. But we don't want to lower them too quickly and jeopardize the hard-won progress we've made on getting inflation down. Low, stable inflation is good for all Canadians. And that's our mandate, and that's what we're committed to deliver. So we are really trying to balance those two risks, and we're going to be taking it one meeting at a time.
And that concludes today's press conference. Thanks to the governor. Thanks to all of you for joining us. Talk to you in a couple of weeks.
Thank you.